Here we go.
Hi, a couple of questions, please. We've been Nicola Wealth clients for a few years now, and we're pretty happy about what's going on. But of course, you always have friends who says, "Oh, I made X number of times more money than that, than what you're getting." Two questions. Okay, so the first question is, I'm very happy with Nicola Wealth's approaches. As I'm happy to get a single and the occasional double, in terms of. Do you guys have any plans to go for home runs? Okay, and the second question is, it relates to what you guys were talking about with oil prices so depressed right now. Is this time, I mean, maybe not within Nicola Wealth, but perhaps we do a certain amount of investing on our own. Would this be a time to invest in some of the oil stocks that have been beaten down a lot?
I'm going to take a run at the first half of the question, and maybe I'll let you take a shot at the beaten up oil stocks, if that's an opportunity. You mentioned about sort of going for home runs or, anecdotally conversations with others that that have had great returns. One of the things that we talked about at the, I touched on it at the opening of at the present, no problem, and John talked about it as well, is the 85% of a return that you get in any given year is going to be driven by your asset allocation decision. When you looked at John's pie chart and the many different areas in which we invest, each one of those asset classes has different returns. So if you broke it down and you looked at the return that our global equity fund returned, I think it would be more interesting to see how did we do as an investment manager on global equities vis-a-vis another global equity manager, or how someone who you were speaking with, how they did investing in global equities. Our global equities fund, 1 year may have returned 28%. But if that was 100% of your portfolio, I'm sure you'd be very happy with that return. But what risk did you need to take in order to get that return? So it all comes down to the design of the asset allocation and the return that you get. And if getting that single-digit return didn't cause you to take a whole lot of risk, but the result that you got from that is getting you to what your long-term objective is, then you need to decide how much more risk are you willing to take to get that additional home run or that additional return.
I mean, just one addition to that, I think when you look at what's happening with monetary policy in the global economy and what central banks are doing by driving interest rates basically to zero or even negative in some countries, they're forcing you out on the risk curve. Because you can't earn anything in a safe asset anymore. I would say this is not an environment where you want to go looking for triples or home runs. I think this is an environment where you want to be conservative. I really worry about that increase in risk and people are taking and how it's based off of a very stimulative monetary policy that at some point needs to be reversed and removed.
So, not that I know a whole lot about baseball, but I think I remember these stats that Babe Ruth, who held the home run record for decades, also holds the record for the most strikeouts of a baseball player as well. And Ted Williams, who got nowhere near the home run crown, had the highest batting average of any baseball player in history. So I guess the assumption is, from our perspective, we think the model that makes more sense for us is to be a bit more like Ted Williams and Babe Ruth as a model for what our clients want and what we think is going to effectively build wealth. You asked about the oil stocks. There's anytime an asset class has a major correction, 30, 40, 50%, and it's fundamentally one that you believe you should be in the long run, it's probably never a bad idea to consider adding more to that position or creating a position in that asset class. But I will give you a cautionary tale on this, because we were pretty sure in 2008, when REITs peaked, real estate trust peaked in 2007, we watched them fall. They fell eventually 70%. By the time they'd fallen 40%, it was cheaper to buy real estate in a real estate income trust than it was to actually buy a building. So we started to do that because our job was to buy real estate at the best price. But it's a bit like trying to catch a falling knife. So we started buying roughly in October of 2008, and that knife kept falling until March of 2009, by which time we had on paper a 30% additional loss. We were comfortable sticking with that program, and we kept buying all the way through that process, all the way through 2009, and generated some spectacular returns after that. But you've got to be comfortable with that. If you start buying oil stocks now, just be prepared for the fact that where you think the bottom is now, it could be another 50% below where it is today.
And because of that, what I would say, because I agree with that, I mean, I think in a few years from now, will oil be, higher? Probably. But I would caution the fact that nobody or very few people predicted this was going to happen. So if anyone's telling you they know where oil is going in the short term, don't trust them because they didn't know. Right. So here's what I would say is, if you want to do that and take advantage of that, go with the producers that have the best balance sheets that are able to weather the storm. Because one thing, it's very hard to judge. No one knows where oil is going to go in the short term, how low it could go. But the other thing is, nobody knows how long it's going to stay low. So you want to be with a company that's going to be able to survive that time period. So I would not go with the more highly levered play. If oil were to go back up, those would go up more. But if oil stays down for a longer period of time, it's like an option that's going to expire on you, and you could lose a lot more money.